For more of our audience to join us, I'm going to go ahead and kick things off just so we are good on time here. My name is Shane. I run the events over at 10 Capital Network. We have a great real estate event for you today with John Jordano, and I'll let him get to it in just a sec. If you have any questions during the session, please feel free to put them in our chat box and we'll get to them if and when we can. And with that, I'm gonna bring up Paul actually to introduce John. So you.
Great. Thanks, Shane. I'm Paul Martin. I'm the CEO of 10 Capital. I want to thank everybody for joining today. Appreciate having John Jordano come on. We invited him to talk about what's going on in the real estate market. Talking to investors, I get lots of questions about what's in the space, what's the investment opportunity, and what are the challenges there. Most of our investors are startup investors, but they do want to look at the real estate space because of diversification and the opportunity that is there. And many are not experienced with real estate. And so that's why we're putting this one on today, is to get more feedback about how to invest in real estate and what's going on out there. We also have two presentations today for you to look at as well, to get a sense of what kind of opportunities are available in the real estate market. So with that, let's go and bring John Jordano up. John, thank you for joining us today. Can you, before you jump into your presentation, can you tell us a little bit about yourself?
Sure. So I started out in technology and in consulting, and then worked in Silicon Valley for a while and made some money there. And then for about 10 years, I did real estate development and investing as an individual, and had some success and got burned a little bit also, and learned quite a bit from that. And so now I'm looking at other opportunities in real estate and doing some technology advising on the side.
Great. And so today, John's going to talk about real estate investments, approaches, risks, and battle scars. And with that, let's go ahead and have John kick off and lead us through this new area. Thanks, John. Go ahead.
Sounds great. Cool. So I want to talk about the different ways to invest in real estate. And again, part of what Hall had mentioned is that most investors are really thinking about real estate as a separate thing from stock market or other things. So how does it compare? So we want to talk about the different types of real estate investments, the average return versus the risk and dangers, and the choices you as an individual may make. So the first question or note I want to make here is long-term real estate tends to be a little bit different than investing in the stock market. If you look at historical long-term trends in the bottom graph here from, forget which company this is from, the red line here shows stock market, the black line here shows holding real estate. If you notice, it doesn't return quite as well, but boy, it has a lot less risk. Now, I don't want to say that's every real estate investment. I would actually say some real estate investments have very high risk. So you got to figure out what you're investing in and who you're investing in. But to Hall's point, real estate also offers a great, or not always, can offer a great diversification away from your other investments, and potentially with higher return if you understand what you're investing in. And if anyone, by the way, has any questions as we're moving along, please feel free to jump in and I can try to answer as best I can. So and I'm going to make a comment here, which is a little bit loaded, but so people investing in individual stocks and bonds tend to underperform the market or even lose money. And I know every individual investor says, oh, I'm doing great and I'm doing wonderful, but the reality is long-term, most people investing in stocks are better off to invest in the market or equivalent. And part of what 10 Capital offers is something which potentially has, if you're smart about it, the opportunity to do better. People investing in real estate as individual tend to actually have good return and lower risk. And so it's part of the reason why it's a good balance to the stock market. And final point I want to make here is what we call scenario analysis versus predicting the market. A lot of people think, oh, I know what the market's going to do. The housing is going to go up, or this cost is going to go up, therefore I'm going to do that, which always sounds great. But there's a guy I knew in real estate development a while ago told me that initial investors try to guess what the market is doing. Smart investors make sure that they come out okay no matter what the market does. So the notion is what they call scenario analysis of, hey, if for your investment or whatever you're looking at doing, picking a set of possible returns and seeing how your investment would do. If the housing market tanks, how's your investment going to do? If the stock market goes down, how's your investment going to do? Okay, and then some different categories of real estate investment. So some common ones that people talk about are actually very low end rental properties, meaning, hey, I as an individual buy a house or a duplex like that and rent it out, maybe do a couple of those. A lot of people do this. And if done well, it actually has very low risk and relatively low investment. Another category I'll call is flipping houses. TV loves to show this. It actually has high risk and a lot of issues. Third category I'll talk about is real estate investment trusts, which can be private or public. Fourth category I'll talk about is real estate development, where I focus most of my time. That means actually buying a piece of land and building something on it, or changing it in some significant way. High risk, it can also have high return. And the final category I'll talk about is what I'll call accredited investing, which is investing in a partnership which requires certain minimum investment standards, but might typically be doing rental properties on a large scale or real estate development. So shorter term rental properties, or not short term, sorry, smaller rental properties. And again, this means, hey, I buy a house and I rent it out, or I buy a set of condos, rent it out. A lot of people do this with good success. It requires some patience. It has relatively lower investment requirements, and it does require also some active management. You got to go there and you got to fix the hot water heater. You got to get it fixed and you got to deal with tenants. So there's hassle associated with this, but it's a good buy and hold and manage approach. Flipping houses, again, a lot. Whenever people think of real estate, they think of flipping houses. Probably, I'm going to suggest, just my perspective, I'm going to suggest probably the worst, most dangerous investment to make. Not worst bad, but just it's difficult. So TV tends to show this as someone buying a house and repainting it, putting in new appliances and making a lot of money. The reality is transaction costs eat up about 10%. So you need to be making more than a 10% change just to break even, if not to mention losing money. And you understand the market really well to do this. I know people have made money on it. Most people lose money on this and then get out. Okay, so real estate investment trusts is a technically defined term, I believe, by the SEC. They can be public. Usually they're not, or they can be semi-public. Usually does not require accredited investor status. And one part I'm going to note here is that they tend to sound good. You tend to have very little control over the investment, low liquidity, but they can be great ways to invest in real estate as a market potential. These tend to also be a little more opaque, my perspective, a little more opaque than what I'll call accredited investor deals. They tend to be selling you on the idea of, oh, we're doing a lot of properties, and they don't really tend to they don't want you typically to evaluate an individual investment that they're making too much, as well as buy into them as a great investment. And having looked at some of these, I'll say be careful a little bit. A lot of these are structured in a way so that if the investment does well, everyone comes out okay. But if the investment does poorly, they're structured to make sure the right people don't get hurt. So be careful if you're in the good pool or the bad pool. Okay, so real estate development is what I spent about 10 years on. And this means, the way I'm using the term here, buying a property and then building something on it, a new house or a set of houses or a set of condos or something like that, and then selling those houses or whatever. Tends to be huge costs and huge risks. The time frame to do it, at least in Austin, is typically a minimum of 2 years because of permits and inspections and everything. It can be great fun. You're actually building something and creating something. And there is potential for significant return, but also for projects to lose huge amounts of money. You have to have a strong stomach to do this. And final one I'll talk about is a category I'll call it credited investing in real estate. And what I mean by this is investing in private investments that usually should require accredited investor status. And in some sense, these are real estate investment trusts, but they're usually more focused, usually have greater understanding, usually a little more local. So REITs typically are investing all across the country in different things. Usually these are ones where you're more likely to know the people involved, to have met them or something, and know the specific projects they are doing. Just like real estate investment trusts, they typically have lower liquidity. That is, typically you can't sell these shares on the open market. But they for people that meet the accredited investor requirements, these tend to be a good, and that want to get into real estate, these tend to be a good middle ground. That is to say, you're not buying properties yourselves and investing in that yourself. You're also not just investing in the stock market or whatever. There are, I don't want to say, and certainly not that every project like this is great. You have to, like everything, do your due diligence. But if well managed, these can make I believe, a good middle ground for accredited investors, people that meet those requirements. Okay, so I went over this pretty fast at a high level. Any questions or any comments, or the people that have joined the call, if you guys would share what you're perhaps interested in, and that might help guide us.
So I have a question. We're in a rising interest rate market. Which of these would be a good investment and which of these would not, given the rates are probably going to continue going up a little bit more for a while?
Yeah, so one comment I would make, as I said before, of while you want to be aware of these things, try not to pick any investment based upon your belief that'll go up or down. But so if we assume that interest rates will go up, and also ask the question of why will interest rates go up? The interest rates go up because of the overall market, but part of that, there's expectation that the housing market will cool, and that construction costs they've been going up strongly, that construction costs will stop going up, and that the housing market will cool. And this has already happened over some part of the country. So let me think here. So if we, some of these investments like rental properties tend to purposely be longer term. So if you have the opportunity to buy a property when it's still a lower interest rate climate, and then the interest rates go up, your investment should go up, is the general approach. With something like real estate development, you can actually get burned, you can get hurt by that. Generally, any change can be difficult to manage. You're trying to do your development, and other changes in the market tend to be difficult to adapt to. For something like accredited investing, I think that's a great example of a question I would want to ask the people doing that. Hey, how do you see this investment, or your set of investments, performing in a rising interest rate market or a different one, and see if they've thought through the different scenarios.
So we're here in Austin, Texas, and the other factor aside from interest rates are supply and demand. How much is available? How much are people wanting? And we have a fast-growing population where there's a lot of people moving to town, so demand's outstripping supply. Is it true that all of these would do well in that case, or is that not the case?
Rental property. So I'll say which ones do comparatively better or worse. So rental properties is more of a longer term hold. It's not going to take advantage of that. As compared to, and flipping houses similarly is very short term. It's not trying to count on the rise, it's trying to get in and out really quick. So it's not bad, it's not taking advantage of that. I think for real estate development and accredited investing in a company which is doing a large scale renters, a large scale development in an area, is where, if people are smart, there's an opportunity to take advantage of that.
Yeah, great. And so I mentioned interest rates and supply and demand. What would be another factor that I should be considering?
So certainly for there's things like construction costs. If you're talking about things that are related to building or constructing, that can radically change the financials of an investment. It's much less of a factor for things like rental properties. There's also the tax implications of these different approaches. So, for example, real estate development, you are typically in the highest, you're going to be taxed the highest rate no matter what. Whereas some of the other investments can be designed or take advantage of tax breaks, such that can reduce your risk a lot.
Okay, great. Cool. So what are you seeing as trends in the market right now? I see rates going up, but what else do you see going on right now overall?
Yeah, so the things that I've talked to the people that are still actively building, so overall in the country, the housing market has cooled some. And there's the expectation that, Austin's going to, because Austin's been going gangbusters the last couple of years, there's the expectation that Austin's going to cool some also. And it's cooled some, but it hasn't even come down flat yet from the people I've talked to. So there's been the expectation for multiple months now that it's going to cool. It hasn't happened. And again, this is a great example, I think, of even the smart people, when they predict things, it doesn't always happen. So and you mentioned something a couple minutes ago, which I think is a great counterexample to what I'm saying, which is, hey, even if the overall country housing market is cooling, if enough people are moving to Austin, that will override that. Austin may go up. Austin and surrounding areas may continue to increase just because a lot of people are moving here, even if interest rates increase, and even if the general housing market cools, and even if all these things, if enough people are moving to the Austin area, and there's a lot, it can overcome that. So this might, I don't want to make a prediction, this might be a case where investing in the general nationwide housing market might be poor right now, but investing in Austin and surrounding areas might do better.
Okay, great. Well, what's the biggest mistake you see real estate investors making out there?
So the two I would say is one of trying to believing that we know what's going to happen, versus, and again, I've been burned with this multiple times. So no matter how well you are doing, there can be changes in the market that overwhelm you. And the second biggest thing, and I think this applies more to Austin than other places, is realizing the difficulties, dealing with permits and inspections and those kind of things. So on the smaller end, like rental properties, there's a little bit of that, but not much. As you move up in this or down on the screen here, I spent a lot of time dealing with Austin permitting departments, and people don't realize. People think, I'm just going to buy this and do that. If you're don't have a lot of experience, you'll be overwhelmed and be in a lot of trouble. So this is an example where if you could keep it, the rental properties, okay, fine. Other than that, I would say you need to be dealing with someone, investing with someone that understands these things well, because you as an investor are not going to be able to understand everything.
So in the residential world, people measure or track the price per square foot in some cases, and maybe
Yes.
other factors. What metrics are you tracking on these things on a regular basis?
So again, the one I mentioned before is construction costs, which, and they have different metrics, price of lumber, different things like that. The price per square foot, I think, is a great one, and I'm going to break this down because it's such a useful one. I'm going to break it down in a couple different ones, which is, I'll say, a price per square foot in a particular area for finished new construction versus price per square foot in the area for something older that's not so great, versus price per square foot or per acre of land for something that's undeveloped, or in a lot of cases has a junky old house on it that's going to be torn down. And so in a lot of cases, it's not it's not the finished price per square foot alone, which is the issue. It's the difference between the two. Hey, how much can I buy this for? Hey, it's a junky old, or it's an older property that I'm going to improve and rent. Well, great. Even if it's a high price per square foot for renting or selling, how much am I getting it for? How much am I buying this for? How much am I selling it for? It's not just the sale price. It is the cost of the land or the cost of the house or whatever you're buying. So while it's a great example of the places that have the highest sale price per square foot may not be the best investments. It might be a lower end one that has the bigger differential there that you can work with.
Well, you see a lot of these things ebbing and flowing in the market. What do you think is the hot topic these days for investors? Which of these are most people trying to get into?
So one or two, and I think some of the presentations or deals later, I think one or two hit on this. So one is the notion of we'll say tiny houses or just things that are what the technical term is system built versus site built. And so the reason there gets before I said of permitting and inspections with the city or other things slow down projects by a factor of 2 or 3-fold. And so building it off site, moving it on gets you around most of those things. So it's much harder to figure out the system where you do all this. But in doing that, you can move much faster. Instead of a 2 or 3 year time frame, you can maybe knock it down to a 6 to 9 month time frame, depending on the project. In terms of lowering your risk, that has huge potential. Despite I'm saying that, though, almost no one has done this and done this well. It's still emerging. Another area I'll say is redevelopment of existing areas. So we've typically thought of building suburban homes on undeveloped land. But as we are growing as a city and as a country, a lot of it now we're talking about a redevelopment of particular areas. And that is great. You'll see like around town, a lot of different condo buildings going up in places where there were old houses or whatever. It has great potential. It's also even more difficult and has higher risk associated with it.
Great. What's your take on 3D printed homes? Do you think that's the future, or is that just an interesting sidebar?
That is a wonderful, interesting question. I believe it's the latter. It's an interesting, I'll say cute thing. I'm not trying to be mean here. So I think the greater potential is the thing I mentioned before, which is what they call system built, meaning they build the whole house or like big chunks of the house offsite, but to your specs. And then you bring them in and place it on the property or attach it on the property. So but then again, this is a great so and I think, correct me if I'm wrong, I think there's 3 or 4 or 5 or 6 supposedly 3D printed houses around Austin now. Is that true?
That's true. Yeah, they're building more and more, and it seemed like they got into, instead of individual houses, they're doing more medium-sized construction projects because it's a lot of work to haul that equipment out there.
Yeah. So simple answer is I don't know, and I'm intrigued. So I need to go visit some of those sites.
Great. Do you have any more slides you want to share?
That's all the science I had done so far, but I can certainly talk about other things if need be.
Cool. And so where's your investing interest today? What are you looking for out there?
Yeah, so again, this from a personal standpoint, I had almost all my money invested in real estate because I was doing development 10 to 15 years ago. And then I got tired of that and pulled out. So now almost all my investment is very liquid. So I am in personally in the state where I'm looking gently for new opportunities. To the question of where to invest, I bring this back to the question: hey, what's a good investment strategy overall? And I've come to the belief that a good investment strategy overall, for people, is to really invest in the market and not try to pick individual ones. But then as you get a little bigger and you have a little more wealth, then investing in individual companies, like a lot of what you guys at 10 Cap do, it takes some diligence to be great. And then balancing that with some real estate, personally, I think makes a lot more sense than trying to pick individual stocks. I think there's greater, I know everyone likes to talk about picking this stock and that stock and day trading and stuff. I think the history bears out that it's wiser to go to not take that approach and to go with a market basket approach, and then combined with some targeted investments in companies or real estate.
So let's talk about asset allocation. How much do you think someone should, given they're trying to be diversified and they have stocks, they have startups, and they have some real estate, how much should be in real estate?
Wow, that is a so I'll say as an initial target, perhaps doing something like a third might be good as a target. Now that's much higher than most people would typically in real estate. I think perhaps a better way to view it is generally the good real estate investments are very illiquid. That is, I'm in and I can't really get out for a couple of years, or at least not without significant penalties. Whereas a stock market basket, you can get in and out every day. And private investment in companies similarly tends to be illiquid. You know better than I do, Hall. So, typically over what, like a 1 or 2 year time frame, depending. So I would look at it instead as, hey, you keep all your money reserves in liquid versions of the stock market and go in and out whenever you want to. And then you judiciously find companies or real estate investments that you do believe in, that sound good and you want to invest in, and knowing that you're going to take some money of that, it's going to be stuck there for a year or 2 or longer. And then when it's done, you move it back out. So the stock market as a general market blend is your kind of basket where you keep your money. And then when you find individual investments, you move in there. Where really, though, I would never have more than a third of my investments in either private companies or private companies or real estate. But anyone, like right now, I have 100% in market basket, but I want to find some other things to move into.
Well, if you get in and out in a couple of years, that compares very favorably to a startup investment where you're in there 5, 7, sometimes 10 years. Although I will say startup investments it is truly unlimited upside potential. They don't all make it, but many do. And we talk about 5x returns, 10x returns, and I've had 35x returns come through our network in the past. What do you think is the average X return on a real estate investment?
So, and it depends on the size. So on the lower end here, the return, rental properties is going to be lower return, but lower risk. When you move down in this chart, so up in the investment size, you're definitely typically not getting I've never heard of one which is a 35x real estate deal. There's probably ones out there. I just haven't heard of it. But you do get, let's say, 2x real estate, well-designed real estate deals over a couple of years. That's a lot more than you're going to make in the stock market. So on that risk return graph, if you want to look at it that way, that's in your head, in my head right now. I would put this in the middle. That is, there's well-chosen real estate investments can significantly outperform the stock market. I don't think they're not going to be a Google home run, but they're also a lot lower risk. So to me, they form a good middle ground and a good balance.
So, but there are tax benefits to this as well. I mean, there's some tax benefits to real estate, but not a lot. You said you're really being charged, ordinary rates in most cases.
So it depends on the investment. And so it can go either direction. So some like rental properties are usually taking advantage of some tax benefits, some of which are questionable exactly about how legal they are when done as an individual. But moving up into the real estate development, so by nature, any real estate development is considered a short-term investment, meaning taxed at the you don't get the long-term cap gains rates typically. But you get into things with well-designed projects can take advantage of specific tax breaks that can be significant, or well-designed investments can balance development with rental. And if done well, you can not only mitigate mitigate the short-term cap gains rate, you can actually, I've seen cases people do it well where they actually get lower than the average tax rate by balancing the two things. And they also, what's the term of realized versus unrealized gains. They can balance that in a good way. And there's also, I haven't actually done it, but there's a way to roll over your investment in real estate so that you don't pay taxes on the gain in certain particular projects. So the real, I would say for real estate, it's a little bit all over the board. It can be worse, and if done well, it can be better.
Great. Well, that brings us to the end of this session. I want to thank you, John, for sharing this with us. We do have a lot of startup investors looking to diversify into real estate. This has been very helpful. Anybody in the audience, if you have a question, go ahead and put it in the chat box, and John can answer that while we move to our next presentation, in which case we have Casada coming up and talking. With that, I'll turn it back over to our Casada team to pick up and show your slides. JB and Noah, go ahead and kick off when you're ready.
Paul, thank you very much for having us today. John, very great presentation there. Thoroughly enjoyed that. I'm JB Sigmund. I'm the CFO of Casada, and I'm excited to introduce you to our platform. We have an innovative solution to the attainable housing shortage. Casada is a high-growth, build-to-rent multifamily developer, and we're focused on delivering high-quality micro-home communities at an affordable price point. That's something that very few developers are focused on these days, because providing attainable housing is very difficult, even though it's a massive under-addressed opportunity. Many developers can't figure out how to make project-level economics work while keeping rents low for tenants with low incomes. But here at Casada, we think we've cracked the code on how to develop high-quality, differentiated, attainable housing communities. Now, this slide is basically talking about what the problem is. And the problem is that there's been decades of chronic underbuilding in the US, and there's been lagging construction sector productivity that's left over 20 million households in this country cost burdened. And by cost burdened, I mean that people spend more than 30% of their income on rent plus utilities or mortgage plus utilities. And at the current pace of development in this country, it's going to take more than 20 years to close the housing gap that exists today. So in order for tenants to stay afloat and afford their rent, people end up making choices and stay in underwhelming housing options, like the couple of pictures that you see on the screen here of Class B apartments. So as I noted previously, we think that Casada is an innovative solution to the affordable housing crisis. The communities that we develop empower low to moderate income families to lease high quality micro single family residences at rents that are in line with typical tired, worn out Class B apartments like the ones shown on the prior slide, but we provide something that's much, much higher quality. So how does it work? Basically, we are developing environmentally conscious communities. Each unit in our community serves as its own single family dwelling, featuring both indoor and outdoor living areas. The concept, the best way to kind of think about it, it's akin to multifamily vertical apartments, except for Casada, we're horizontal. Every unit is its own standalone building with indoor and outdoor living areas and access to common area amenities for residents. And we've laid the groundwork for rapid growth with partnerships that are nationwide manufacturers. And those manufacturing relationships are really what drives the returns for us. It allows us to reduce our project costs by about 20% on average and accelerate timelines by up to 50%. Our homes typically range from around 400 to 1,000 square feet in 1, 2, and 3 bedroom modules. They're tech-enabled, they're modern, they're eco-friendly, and have highly functional layouts. They use energy-efficient materials, and they have high-end finishes. And we've seamlessly integrated technology into all of our homes, including the development of proprietary dedicated mobile app where residents can manage all of their needs and control their smart home. We also provide an enhanced resident experience through premium amenities and community building events, such as planning for on-site concerts, fitness classes, volunteer opportunities, and additional things over and beyond that. So we think this really represents a huge competitive advantage to what else is in the market today. There's multi-family communities that everybody's familiar with, your typical apartment complex, and then there's single-family communities of, basically single-family homes. And we fall somewhere in between both. Unlike traditional multifamily developments, our communities feature units that are completely standalone, don't have any shared walls, ceilings, or floors, and it provides tenants with a level of independence that you typically would only find in much, much more expensive single-family homes. But unlike single-family home communities, our communities provide physical amenities such as, naturally landscaped buffer areas. We have co-working spaces, fitness centers, outdoor pools. We have extensive green spaces, dog parks, and community gardens. And so even though that Casada is providing a much higher quality of life for our tenants, our rents end up being in line with your typical Class B apartment complexes like the ones that we're showing in the pictures on the right-hand side. And the pictures on the left-hand side are actual pictures from our community in Austin. Speaking of our Austin community, we have already done this. This isn't just, a pie in the sky dream. Our first community was built in February of 2022. It was 66 units, and we finished it in under 12 months. That's 2 to 3 times faster than it would take to build a typical apartment complex. And the community was a huge success. It opened up 82% pre-leased. It stabilized, meaning it got to, north of 90% occupancy in 90 days, and it was 100% occupied within 120 days. And we've already recapitalized it and refinanced it. And so that means that we basically leased up the project roughly 4 times faster than a typical development. It usually takes about a year to lease up an apartment complex, and we leased up in under 4 months. It's also worth noting that we nailed our target tenant demographic. You remember on the very first or second slide on here, we showed that we're really looking for that, kind of low to moderate income tenant that's around 80 to 120% of median income. Our tenants came in with median income of $51,200, which is around 80% of the median income for the Austin metro area. Now, we've already developed an active pipeline for our next 3 communities, which are going to yield about 600 units over the next 18 months, starting in San Marcos, where we'll break ground this summer, Bastrop this winter, and then College Station in the spring. Our initial focus is expanding across Texas into multiple high-growth areas, including the DFW market, Houston, and San Antonio, and another project in Austin. And we've also already received strong interest outside of the state and anticipate launching our first out-of-state project sometime in 2024. We believe that the demand for this project is huge. It's more than we can even be able to build in the time allotted. We think that there's the ability to build somewhere from 100 to 200 communities, which should be about 35,000 units over the next decade or so. We've got the right team already in place to go ahead and expand at this type of rapid clip. We've got deep development, capital markets, deal structuring, and operational experience. Aaron Levy, our CEO, is a multi-generational real estate developer. He's got over 15 years experience building in the Austin, Texas market. Our COO, Noah Pollack, has over 30 years experience leading high growth organizations. I'm the CFO of the organization. I've got over 15 years of capital markets and real estate experience, across Wall Street. We are currently closing out a $2 million Series A1 round. We've already raised about $700,000 of the round. We're open to being oversubscribed potentially, but we've got a little bit of room left in this round. This fundraise, the purpose is to alleviate Casada's near-term cash flow gap and accelerate our growth of our pipeline. Now, I'll quickly run through how does Casada make money. And basically, each Casada community is a separate special purpose vehicle, and Casada serves as the developer, the operator, and the general partner for every community. The rest of the project on each project is financed separately through third-party limited partner capital and construction loans. A typical Casada project's around 200 units, and we spend about $200,000 per unit developing the community. That means about every project is a $40 million project on average. We end up, as Casada Corp, ends up investing about $1 million into each project. That's about 10% of the total required equity on the project, and the rest is financed, as mentioned, through limited partner capital and construction loans. During construction, we earn a developer fee, which is based on the total project cost, which means we of about 4%, which means that we recoup all of our initial investment within the timeline of building the project over the next 18 months or so. Once the project's finished and leased up, we'll charge management and licensing fees that are equal to about 4% of revenue. But the big driver for value for Casada, just like any real estate investment, is from the ultimate sale of the project And as the general partner of the project, we have a carried interest in it. In order to incentivize Casada to maximize returns to those limited partner investors in each project has a profit sharing waterfall put in place between Casada and the limited equity partners. And this profit sharing arrangement provides Casada an outsized return if the project hits certain targets. And this is our carried interest. So our carried interest in each project will be about 30% of the total distributions to equity when the community is ultimately sold. Even though we only put in 10% of the equity, we walk away with about 30%. So when you add up the developer fees that we get, where we earn our money back while it's under construction, plus the fees we earn from asset management and licensing while it's operating, and our big carried interest at the end of the day, Casada ends up making somewhere between 7 to 10 times our initial investment into every single project we build. And in terms of scale, we've basically built out the pipeline and we built out the team capable of breaking ground on 4 projects a year. So our goal is to build $1 billion real estate portfolio within the next 5 years. So I know that was rapid fire. So Paul, what questions can I answer?
So I think the first question is, you built the Austin facility already, or an example of this in Austin. How did that build out go? Was it on time and under budget, or how did it work out at the end?
At the end of the day, it was slightly over budget first time we'd done it, but it was on time. We built it in 12 months. We broke ground in February of 2021, opened in February of 2022, which is astronomical.
And what did the residents like about the tiny homes versus the traditional apartment or condo?
What's really neat about what we've been able to do with these units is, if you think about your typical Class B apartment, you've got low ceilings and you got people on both sides of you. Instead, you go into a Casada unit, the ceilings are lofted, they're 10 to 12 feet tall. You've got light coming in on all 4 sides, windows everywhere. The units are totally standalone. So it ends up feeling much, much larger than what it would otherwise if you had the same square footage in an apartment complex. So people love that sense of independence. They love the sense of light and airiness to it. And they really love the sense of community that they've gotten, through all the community building events and everything, all the, planning that we do, at our communities.
And what did the builders think about doing that? We have a poll in the audience for investors. If you like more information, you can click there. But my next question is, I sometimes I'm seeing houses where they say it's an architect's dream, but a builder's nightmare. And just wanted to see, well, how did builders find in building out the tiny homes facility?
So that's one of the key things here is our units are all manufactured off-site. That's how we're able to do this at rapid scale and at low price points. So we work with nationwide, manufacturers like Clayton Homes, Champion Homes, Box Prefab, Involve, a number of other ones all around the country. So they take the designs that we've actually come up with. Aaron, our CEO, is an architect and has come up with all these very highly efficient floor plans. And then we work with manufacturers to actually build in the manufacturing center our designs. So we're not having to deal with those kind of like general contractors on site trying to figure out what to do. Everything is set up and tooled in the factory.
And this is considered affordable housing, is that right?
I would call it lowercase a affordable or attainable housing, as opposed to capital A affordable, which is typically Section 8, where there's some sort of government subsidy. Our units are priced at a low rent rate that is affordable for people, but it is not based on some sort of government subsidy that makes it affordable.
Okay, great. I think that answers the questions we have for now. Let's go ahead. Thank you for the presentation. Let's go ahead and bring up our next presenter. Eric, if you could go and come and talk about balconies. Love to hear more. This is Eric Denton, and we'll kick off with the next presentation. Go ahead, Eric. We see your slides.
Perfect. Before I dive in, John, there's a couple things I wanted to follow up from your presentation. I really loved your statement about don't follow the market, but protect against it. It's kind of a tagline I use that I tell people it's not my job to speculate, it's my job to mitigate. I think that's really important on this. I think in the private world, that means a lot of stress tests. It means a lot of leverage analysis, making sure you have the staying power, and then making sure that your value adds pretty substantial in the real estate space. So anyway, I just wanted to second that. I think that point is spot on. So Balcones Land Co., I'm one of 3 managing directors with this company. We are a Texas land developer, and our goal is to bring the ranch way of life forward for people to enjoy. We all kind of have ranch upbringings, and there's a lot of, wonderful benefits to that. The truth is, though, that over the last 20 years, Texas ranch land has become extremely expensive, and it has always been very difficult to maintain. It just takes a whole lot of work. So we've also noticed along the way that you can get a lot of those ranch benefits and that, nice way of life on 5 to 50 acre tracts as opposed to 1,000 acre tracts. So our goal primarily is to buy 200 to 1,000 acre tracts and cut them into 5 to 50 acre kind of ranchettes that people can buy and enjoy at a much, lower barrier to entry and, less maintenance going forward. The sponsors, all 3 of us, have individually developed dozens of projects. As a team, we started our company 2 years ago. We've had 2 full cycle deals where we've hit, we've fully liquidated and hit targets to our investors. We have 2 current projects underway. One of them actually went under contract on Friday, which with that closing, it'll solidify a win and our target returns on that one. And then the 5th project is the one I'm presenting today. This project is the acquisition of 6 lots that are 5 to 7 acres each from the 464 Ranch community. That is an affiliate entity. It's one of our projects that's underway. We bought 464 acres, subdivided into 72 lots. It's a beautiful community. It has high fence all around it, wildlife exemption to all of the lot owners. So everybody's paying a very much preferred property tax payment. Nice community park in the middle with the gazebo and a mail room. So very, very high end kind of ranchette community. Then we're going to buy the 6 lots and we're going to build 6 single family residences on them. It's in 2 phases. So we'll build 3. And as the first sells, we'll begin construction on the 4th. Each house plan is between 3,500 and 6,000 square feet. Our build cost is projected at $378, and the market out there is selling for about $570 a square foot right now. That gets us to a total price point for each home of $2 million to $3.5 million bucks. The terms on our deal is we're raising $2.2 million in equity with an ability to raise up to 2.5. The only reason we fill it up to 2.5 is if we get pushback from the lenders. I typically would have a tremendous amount of confidence in 2.2, but the lending market's just more uncertain than ever. So I wanted to bake in that buffer if we needed it. Investor return, 14% fixed preferred return plus 50% of the upside. The projection shows sales of the first 3 homes in 12 months. So return of capital at that time. And then as phase 2 finishes up 24 months from beginning, should hit the 36.8% target return to our investors, or IRR. The only fee we're taking is a 20% GC fee. We think that's pretty market for general contractors. So we're not taking a fee as the manager of the entity or an acquisition fee or disposition fee. We just take 20% of the construction costs. Part of that 20% fee will go to pay our full-time project manager that's going to be on site every single day. Our location is Johnson City in Blanco County. John, another thing that you mentioned was how difficult permitting is, especially in Austin.
Yeah,
it is quite the opposite in Blanco County. Once we buy these lots, there's permits for septic that are pretty simple, but we can pretty much build as soon as we have architecture plans. So there's not much of a holdup in this county in that area. Johnson City's 1 hour from Austin, 1 hour from San Antonio. It's right alongside the wine triangle. There's 60 wineries or over 60 wineries in the area. Really booming area. One of the reasons we started Balcones is because we had seen a very large mass migration from urban to rural. That's driven partially by people being able to work remotely, wanting more elbow room. And we're seeing a lot of the revitalization of the sleepy communities around Austin. Johnson City, Lockhart, all of those areas are really starting to take off. My favorite data point about this location is that the average AGI or adjusted gross income for people moving from Travis County to Blanco is $394,000 a year, which is 3 times higher than any other county to county data point. It really shows us that the affluent, wealthy people in Travis County are migrating west to Blanco County along that wine triangle. And that's the biggest data point that gives us confidence in our $2 to $3.5 million price points for these homes. The most important thing and discussion around real estate right now is this current market and interest rates and the timing of everything. In Johnson City, so far, we have seen a slowdown in volume that's been pretty substantial, but little to no drop in actual pricing. So we've kind of built in the, in the model to be able to take more time to sell these. But we haven't seen a drop in pricing yet, and we don't foresee one coming. We also anticipate rates to pull down in the next 12 months and then volume to rebound. I think that most finance and real estate people say that in the next 12 months, those two things are going to happen. And that's why timing for our project makes sense, because we won't bring phase 1 to market to sell until July of 2024. And then phase 2 won't be taken to market till Q2 of 2025. So there's a lot of things moving. Demand, we think, is going to increase. Supply has been decreasing because, some builders are a little bit more nervous. Some builders are struggling with their debt and equity and just can't move right now. And we think that the pullback in supply and our speculation on increased demand makes mid next year a really good time to be bringing these to market. Another big piece is the foot traffic that's on the 464 Ranch community. We have 72 lots that are being sold, and we already have, 6 to 10 showings a week on the property. That's a lot of people looking at this property and who are going to be driven by a broker next to our homes that are under construction for the next 12 months. We think it's not only possible, but probably pretty probable that we'll have contracts on the homes before we finish them, just because as they're nearing completion, someone shows up and says, oh, I can buy this lot and build a house on it, or I can just buy this completed one. All we need is 3 people to say that. We've got them sold. Interest rate risk, another big topic of discussion today. Frankly, for this model, our interest rate risk is demand. If interest rates continue to rise over the next year, demand is going to drop. It's just more difficult to sell a home if interest rates are higher. Again, our speculation is that they pull down, but what we've seen in the market with volume dropping, but prices staying strong, we think that even with the pullback in demand, we just need to be patient. Interest rate risk for us as a cost, it frankly doesn't move the needle much for our investor returns. A 1% increase in our, cost of debt causes a 0.3% drop in returns to our investors. The reason why it's so small is construction loans start at 0 and they fund up over the construction cycle. So your average leverage is only half of your debt throughout the whole project. So it's just, our average leverage on this project's in the 30%. So it's not that impactful. What's impactful is where demand sits. Our team, Chris Horn, he's a commercial real estate broker, an entrepreneur. I've known Chris for 10 years. I was his banker 10 years ago, actually. And then 7 years ago, I jump shipped and started my own practice for CFO and kind of capital advisory services, and became the CFO of his hospitality company, and have done multiple projects with him since then. David Gedalia is one of his lifelong buddies and high school friend. He's a multi-generational builder and developer. He was on site in his teens and project managing in his 20s. He's been really profound in our projects. His ability to understand what our costs are and managing labor forces is pretty impressive. And I'm Eric. I'm a commercial lender originally, went into investment banking, was a managing director at Westlake Securities for a while, and now I do capital advisory and CFO services for growing entrepreneurs. Really, really heavy on the strategy and capital advisory and acquisition fronts. Here's our sources and uses. This is pretty simple and self-explanatory. I think the 2 things that I want to point out is this is just phase 1. It's not phase 2. And you can see that we take down the land for the first 3 lots and then also the 3 additional lots on the front end. There's 2 reasons for that. The first reason is we want to buy them before other people show up and buy them. We have 6 lots that we've already kind of pinpointed that would be great to build on. Also, as this project moves forward, we think prices are going to increase. That's pretty typical in lot, development and sales. The road's not quite finished. As the road gets finished and there's less and less available, people are just going to be willing to pay more. So we think we're getting in kind of on the ground floor to take those lots down right now. The second reason is we're going to use them for collateral for the construction loan. So other than that, this is all pretty simple. Financials, I mentioned stress test earlier. I try to do this on all my models. The middle column shows our projection of exactly what we're, our best guess of what we're going to pull off. $570 a square foot for sales price, produces 3.4 in net income for the partnership, and returns $4 million back, or 187% cash on cash, and then 36.8% IRR. If we beat our projections by 15%, then we'll hit 242 cash on cash. And if we stress it with the 15% market pullback, our investors still get a 32% return on their money. So that's all I have. Happy to turn it over to questions.
Great. Invite John, if you have any questions, to pop up and ask them. Those in the audience, if you're interested, go ahead and vote on the poll for your level of interest. And my question, Eric, is you've done this before. What kind of result did the investors get on the last go around of this model?
So our first deal that we went full cycle on was 230 acres. We cut it into 46-acre tracts and took it to market. And we had a 1031 buyer who was looking for the tax benefit of that. He stepped in and bought the whole thing. And that was, I think, 0.5% below our revenue projections, and then hit our target returns for our investors. So that was a big win. The one that we just got a contract for on Friday, that will return all of our investors' capital within 15 months. And then the target return after, there's a sliver of commercial frontage that still remains to be sold. So the contract will give them all their money back, and our projections of what the frontage is worth will hit a 44.5% return to our investors in 15 months. Great.
And then what do you think is driving the growth in this area? Is it truly retirees moving out there, or the high net worth? 394 AGI just seems pretty high there for retirees. What do you think is going on there?
I don't know who of everybody's who's on the call who's been out there. The Wine Triangle, it's basically the strip between Fredericksburg and Johnson City, and technically down to Blanco, but a lot of the wineries are on that 290 frontage. There's just a lot to do. There's wine tours, there's really cool vineyards out there. It's, Fredericksburg and Johnson City are really neat little towns. I think the area is just really cool and people like it.
You think it's more of a Napa Valley scene rather than just a rural scene, it sounds like.
Exactly. People have different speculations on that point. Some people say that this, we're nearing being able to be Napa's rival, and eventually we'll get there. Going back to the, I don't speculate, I mitigate statement, if we get halfway there, this is going to be a huge win.
Yeah, absolutely. Well, I think that brings us to the end of the questions there. So appreciate you sharing that with us today, Eric, and thanks JB and Noah for your presentations as well. And also want to thank John Jordano for a great rundown on real estate investing. Many of our investors are startup investors and are looking to diversify out into real estate and trying to figure out where to play in it and how is it the same or different than startup investments and stock investments, which they've done a lot. But appreciate you guys sharing that with us today. We have recorded it. Those on the audience, if you have any questions, we'll be reaching back out for any feedback or questions you may have for any of these speakers, and love to hear your thoughts and about that, and looking for your recommendations of who we should have up next time. But with that, we'll go ahead and close it out, guys. We're at the end of our time. Appreciate everybody joining us today, and we'll go ahead and see you guys next time. Thanks so much.